Hello, investors. This is Don Vandenbord, Portfolio Manager at Revere Asset Management, and welcome to today's Lunch and Learn. The webinar is titled Breakout or Breakdown, as we set up some rules to try to determine what direction the market is going to take next and what our reaction to that decision will be. I'm going to take a look at the last 8 months of the market, focusing specifically on the last 6 weeks as we initiated our plan to re-enter the market after a very quick and harsh bear sell-off that saw the S&P 500 drop 35% from its high. We kind of had a dress rehearsal for this in Q4 2018 as we followed our rules, exited the market. The sell-off only ended up being about 20% from top to bottom over 3 months. This one much harsher, as I discussed, but when you follow the rules and apply them methodically, regardless of the time frame and the situation, you can keep yourself out of trouble. Over here on the agenda on the left side of the screen, first I want to point you to our website, revereasset.com. If you're not familiar with it, it's just a treasure trove of information and education. Every night, Tim and I record a 10-plus minute daily market insight video describing what actions we're taking in the portfolios, what we see happening in the market. On weekends, we record a podcast. Lately, we've been doing video podcasts, so you can watch what we're doing as we discuss it live on the charts, or you can just listen to the audio. And if you're interested in contacting us, here we are, and here's our contact info, either Dan, Tim, or Don at revereasset.com, or you can call us at 855 Real Wealth. We are a registered investment advisor, conflict-free, completely transparent, and what we seek to do is to protect the downside of our investors' money while participating in the upside. Also, all of these webinars have been archived on YouTube. If you go to YouTube and just search for Revere Asset and subscribe to it, you'll see we've got 13 videos out there right now. The most recent one we did on 4/15 as we started our recovery plan, and this is a continuation of that process. So as I mentioned, topic today, breakout or breakdown. What's next for the market as the S&P 500 bounces into the 200-day moving average? I'll take a look at some stats here for a while. A lot of people that are familiar with our work know how important the 200-day moving average is to the health of the overall markets, and want to remind you, it's not how much you make in the market, it's how much you keep. And then at the end, I'll do Q&A and charts on request. So let's get started, first of all, with the agenda. Talk about some studies I've done on recent bear markets. Also talk about our approach to the markets. I touched on it a little bit. Sequence of returns and how that's an important concept. Then we'll go over the prior 8 months, the rally up into the top as it happened, the warning signs that things could be getting dramatically worse, the escalation lower and identifying the bottom, and I'll also talk about some hedging techniques. And then our re-entry plan and how we focus on relative strength leaders and earnings gaps to determine what the best stocks are going to be during the recovery process. And then we'll talk about what's next, but we're not going to make any predictions here. Anybody that follows us knows we don't predict. We're going to let the market decide for us, and we recommend you do the same. You have a myriad of opinions on Wall Street and on social and financial media talking about the market is absolutely going to crash because of how horrific the overall economy is and how terrible unemployment is and how states are staying locked down. On the other hand, you've got a lot of people saying we're going to recover just fine. We're going to bounce in Q3 and Q4. Now's the time to get in. We don't hold a feeling either way. What we prefer to do is to let the market decide for us, and we'll do that by watching what leading stocks are doing, the moving averages on the overall indexes, and various support and resistance areas. And this is no different than what we do every day when we're evaluating the health of the overall market. So let's get started back in, let's talk about previous bear markets. I did a study late last year going into the beginning of this year because we were concerned that the big sell up, the big melt up that we had in 2019, very strong period in the markets. We were determined to make sure that our followers and, of course, the portfolios that we manage in-house maintain the bulk of those gains. And we want to dispel some myths right away for the buy and hold crowd out there. You often hear people in the financial media trumpeting buy and hold and saying, well, what if you missed the 10 best days of the market? Well, and my response is always, well, what if you missed the 10 worst days? Nobody ever asks that question of anybody live on TV, though, or in print media. Very rarely, if ever. And I'm okay. I'm not worried about it. My portfolio is diversified. Well, that's not true either, because as you saw in the harshness of the sell-off, bonds were sold and gold were sold as harshly as stocks were, because when you got forced selling, everything goes out. The baby goes out with the bathwater. There was a big panic, and that certainly decimated every portfolio, regardless of how diversified you thought it was. So I did an analysis of the past 11 bear markets, and the conclusion, which we had discussed a lot in-house, but we wanted to put some data behind it. We kind of knew it, but the market does not get into serious trouble unless the S&P 500, which is also known as the SPX, breaks the 200-day simple moving average. On a daily chart or on a weekly chart, it's the 40-week moving average. And quite simply, this is just you add up the prior 200-day closes of the S&P 500, you divide by 200, and you plot it on a chart. And if the current price is above it, it's a healthy market. If it's below it, you are getting into the risk of where the market could get into serious trouble. The 87 crash didn't happen until we broke the 200-day moving average. The 1929 crash didn't happen until we broke the 200-day moving average. And this harsh sell-off that we just recently had didn't really escalate down until we broke the 200-day moving average. So we put some simple rules to it to avoid big losses. We want to make sure that we are, for the most part, out of the market to the downside if we close 1% below the 40-week moving average. And then, of course, every exit needs a reentry, and a reentry plan would be if we get back 1% above the 200-day moving average. And we're not there yet. We're within about 1% right now of the 200-day moving average. We expect a lot of resistance there, and we'll see what happens if the market can get through it or not. But the results of the study of this bear market, that's 11 bear markets since 1968. The average drawdown meaning from the high to the low, is 33.3%. That's the average of the prior 11. This 12th one that we just had was slightly over 35%. The high to the sell drawdown, which means until we get our sell signal, that is the 1% close below the 40-week moving average, the average drawdown is 11.2%. It's not that difficult to recover from an 11.2% drop in your portfolio. The key is what happens if that escalates lower. In this case, because it happened so quickly, the high to the sell signal was a little over 13%. So still pretty much in line with the study of the prior 11. Now, the average sell, once you hit the sell button, it saves you on average 22.7% of additional pain. That is from the high, that is from where you sold all the way to the bottom. And that's exactly the number that was saved in this case too. We got out minus 13%. The sell signal came on. We went all the way down to minus 35%, so 23% of pain saved. This is the key thing here, the key rule that we follow. This is what allows our clients to sleep well at night, and it'll keep you out of trouble once you make sure that you're out of the market when you get this 1% or more close below the 200-day moving average or the 40-week moving average. And then your average re-enter point is 9.4% below where you exited. We're nowhere near that situation in this case. In fact, if we had to re-enter right now, we'd be re-entering basically about where we exited, because the time has been so compressed of the sell-off and the recovery. So as far as dispelling the myths, what if it's okay to miss the 10 best days? I've added another stat here to the stats that we talk about frequently. Just remember here, and this is key to the 200-day moving average and why we want to be out of the market when we're underneath it. Since 1960, 22 of the worst 25 days in the market and 83 of 100 in the S&P 500 occurred under the 200-day moving average. So these people that talk about missing the best, they'll never address missing the worst days. Now, the overall average return for the S&P 500 on a monthly basis is a positive 0.88%, but when you're under the 200-day moving average, the average return is minus 2.6%. That average is minuscule compared to the harsh sell-off that we saw in this case, the additional 23% below, which happened in a matter of a couple of weeks. A new stat that was recently published on Forbes, since 1979, 88%, that's 71 out of 80, of the combined count of the best and worst days happened under the 200-day moving average. The main point is that you get the best days and the worst days when the market is in panic mode under the 200-day moving average. So you're not going to get the best days without the worst days. Conversely, you're not going to get the worst days without some of the harshest rallies, which are bear market rallies are very strong. But the point is if you're out, you're not really concerned about it because those strong best days are also going to be sandwiched around the worst days. The main point is, of course, we want to get out of the way if we're below the 200-day moving average. So going back to the previous bear market stats, our approach to the markets, let me bring in a chart of the S&P 500. This is a monthly chart, and quite simply what we're trying to do, you can see long-term the market trends higher, but these rules allow us to avoid big, harsh, soul-crushing losses like happened back in 2000 to 2002 when the tech bubble burst and we had 9/11. Same situation with 2007 to 2009 when the financial crisis hit. Same situation here in late 2018 when the Fed got on the wrong side and we started having a harsh sell-off. And then, of course, what's going on right now with the coronavirus situation with the very sharp sell-off and the sharp recovery. Once we break the 200-day moving average, you don't know how harsh you're going to go down, and you don't know how long it's going to last. So going to a weekly chart now, you can see how harsh this sell-off was. But once again, the red line here, the black line is the 40-week moving average. And it's not until you get below that that you really start to get in trouble. And you can see now we're starting to approach back up to that black line, which is the 40-week moving average on a weekly chart, or right near this 3,000 level on a daily chart. So this is the breakout or breakdown situation that we're going to be looking at, and we'll talk about a couple of rules here. A couple of positives here. We can see that we've been trending above this green line. That's the 21-day exponential moving average. That's what we use in-house here to determine the strength on a short-term basis of the overall market and of individual stocks. The red line, this is the 50-day moving average. Something positive is that this has stopped going down and it's starting to curl back up right now. And this is part of the recovery process that you go through after a harsh drop. So let's go back to the agenda. Our approach to the markets is to get out up here, look for bottoming signals, which we had some. The market actually bottomed on 323, but really what we're looking for is something called a follow-through day, when the market goes up on a significant amount of volume more to the prior day, and you want this to ideally happen 4 to 7 days after the bottom. In this case, it happened on the 9th day. So the key date right here was April 6th. This is when we really started engaging and getting back into the market. And you can see this has led to a nice 6-week rally off the low. There's been one test of the 21-day during this process, but we've survived it just fine. So we've got support underneath. Now we've got resistance overhead with this 3,000 level and the black line, which is the 200-day moving average. So sequence of returns is also something I want to talk about and why it's so critical to get out of the way. On average, the market returns, roughly 8 or 9% annually, but you don't get that every year. The markets would be a piece of cake if you got +9, +9, +8, +7, +10 every year. It's these harsh sell-offs that happen, especially if you're approaching retirement, that you really have to avoid. You've got to have a plan to get out, and you've got to have a plan to get back in. If you want to do it yourself, that's fine. We're all about education here at Revere, setting up some rules so that you can do it yourself. If you're not comfortable doing it yourself, by all means, contact us. We would love to manage your portfolio for you. So let's take a look at the prior 8 months in the market. First of all, we'll talk about the rally. So again, daily chart on the S&P 500, and the rally really started on this day here, 10/11/2019. We had been chopping around for the most of the summer, tested the 200-day moving average, and it held. So this is why we really don't get out of the market until we see a harsh break for more than a couple days below the 200-day moving average. You can see it bounced here in June, it bounced here again in August, it bounced here again in October. If you were expecting a bounce this year, you didn't get it. So this rally, kicking off on 10/11, finally topped a nice 5-month rally all the way to 218 of 2020 before we finally broke over when coronavirus and the oil war that's going on started making the headlines. So you can see the first harsh day down. We started reducing some up here because we saw some of the leaders starting not to act okay, but we're still above the green line. That's the 21-day moving average. The next morning, we had a big gap down on 224. This was the first time that the coronavirus was really starting to get into the headlines, and there was also an oil war going on, as I mentioned. It only took 4 days until we broke below the 200-day moving average, and then we finally got our weekly close here on 228. So that was the long-term sell signal. It's kind of standard that you get a bounce. We got bounced back for a couple of days above there, but we never had a weekly close back above it. In fact, 3.5, the weekly close was below the 200-day moving average. So long-term, we're under the 200-day. You got to be concerned at this point. You have no idea how difficult it's going to get. So then we had on 3.6 a big gap down as the Fed recognized that this may start becoming serious, and they started cutting rates, and really this led kind of to a panic. You gap down, but we finished high of the day. The next day, I think this is when they started canceling some NBA games and stuff like that, and people are really starting to see it impact society. And you can see the free fall that happened over the last couple of weeks. So those are our get out rules. We're out up here. We're monitoring the situation as it goes down, and we're looking for some sort of a bottom. This is called an island bottom, when you have 1 day of action that sticks out below the rest of it. And we started taking a couple of positions in here. This little gap down here made us to start second guessing ourselves and sold a couple of more things. But then this big gap up here on 4.6 got us in a major way, starting to get back in, because you can see that's the first time that we got back above the 21-day moving average since the whole drop down started up here on 224. And it also got us back above these most recent highs the prior week that we were unable to get above as we ran into the 21-day, which acted as resistance. So now think of it as a ceiling and a floor type of thing. You can't get through the roof or the ceiling. In this case, you did get through the ceiling. Now you want to see this 21-day act as a floor if we start testing it. And it's been successfully tested here, one close below it here, but back above it. And you can see the big gap up that we had on Monday of this week. Now we approach another ceiling level, another resistance level at this 300. So that's the next thing that we're keeping a keen eye on. So we talked about the top, the rally, the top, the warnings, the escalation lower. Let's talk about hedging techniques first of all. When you start to re-enter the market and you start accumulating stocks that you have your eye on, I had what I was calling a Fab 5 of stocks. And I started buying small positions of them in here. But when we broke below here, I didn't want to sell them, but I wanted to get back to where I was really neutral with the market because they were leading stocks, they were showing relative strength, and they were showing strong price action. So what I did was hedge them, and basically you take an index like the S&P 500 or the Nasdaq 100, and there are ETFs that trade that go down when the market goes up. So for example, if you have a 25% exposure in your stocks, there's an ETF called the PSQ that goes up when the market goes down. Conversely, it goes down when the market goes up. But what we're trying to do is to stay somewhat neutral without having to sell the good positions that we accumulated. So the PSQ, when we went into this island that I talked about, this 3-day gap down, I wanted to hedge, so I bought an appropriate amount of PSQ to hedge against my longs, and then started to take it off and add additional longs back as we got back above. This is basically what we're trying to do, is smooth your equity curve, smooth the returns, so that your returns are more of a smoother line from lower left to upper right, and not something that's very jagged that works on your nerves. And another way to hedge, and something we do in-house, if clients transfer in a large position in a stock, let's say it's Microsoft in this instance, find a stock or a sector. For example, you could hedge this with XLK, but I found one that would work very well with Microsoft that kind of travels very similarly to the way Microsoft does in Adobe. So if you have a large taxable gain in Microsoft and you don't want to sell it to sell the taxes, you can take a short position in Adobe. So basically they kind of move in lockstep. You can see it here. This is going back over the prior year. It's not perfect, nothing ever is. But if you shorted Adobe while you had Microsoft up here, you can see Adobe dropping 35% during this period, while Microsoft dropped approximately the same amount. So you can be making gains on your short in Adobe while your Microsoft stock is losing, and not have to pay the capital gains by giving back or by selling the stock. So this is an example of hedging. Another example is, let's compare this to just an ETF. You can see the XLK moves very much in line as well as Microsoft does. You can put up the QQQ, you can see it moves very simply, very much the same also, and that's another way where the PSQ can be used to offset the individual positions that you have. So basically, if you have something, you have a large taxable gain on it, you don't want to sell it, you can use these various hedging techniques to not have to get out of the individual position. So that's our talk on hedging. Now let's talk about the re-entry plan, relative strength leaders and earnings gaps. So first, let's address some relative strength leaders. I had what I call the Fab Five. These were the first 5 stocks I wanted to get back into. And basically what I'm looking at is big leading stocks that were performing well in the market, but remember, they're not going to hold up when the market starts going through a harsh sell-off. But this blue line here is called the relative strength line. This line indicates how an individual stock is doing versus the overall market. So as you can see here, while the market started to come down, Microsoft was coming down also, but its relative strength line was staying relatively stable. And then you can see it had a big sharp move up here. This is one of the first stocks that I bought off the bottom. I wanted to identify Microsoft. Also Amazon was one that I wanted to get back in. Let's take a look at the Amazon chart. Note how Amazon, this blue line, was trending higher even while the stock was going down. This means on a relative basis versus the market, this is outperforming. Another one that was on my list was Vertex. This is a cystic fibrosis drug stock. Notice how it's coming down. The relative strength is continuing to go higher. Another one was Dexcom. This is a diabetes monitoring. Note, while it's coming down, its relative strength is trending higher. And then AMD was the 5th one. and note while it's coming down, the relative strength started trending higher. So that's one key to get back in, focusing on relative strength leaders. Another one is when you're determining what the best stocks are going to be that you want to buy is earnings gaps. So this is a list of earnings gaps. So let's talk about what these are now. Really what they are is inflection points. So stocks, tend to go up and tend to go down, but there are periods during this life cycle where there are some extreme moves made, and these are usually tied either to big news announcements and or just a simple earnings report where they issue either blowout earnings or extremely disappointing earnings. I'm going to break these into 5 different types of outcomes, or 5 different types of moves, and there's 15 outcomes based on 3 outcomes based on each one. The first one is an extreme gap up. This is the most bullish. So this is a stock that is in the process of forming a base, kind of going sideways. They announce earnings or some news, and it gaps up on very extreme monster above average volume, and it gets a big price move. These immediately should go to the top of your watch list. Many historical big winners started with these extreme gaps up off of an earnings report, and really you're just looking for a way to get into the stock at that point, because if the market's going to go higher, history dictates that these are going to be leading stocks that are going to continue to go higher. The second type is a more mild gap up, which is just a less extreme example of the prior. It means it really didn't clear all of the resistance. It's still in a base, but it had nice volume and it moved up strongly on earnings. This again indicates that it's being accumulated by hedge funds, pension funds, mutual funds. These are the players that really move the market with their buys and their sells. The second one we'll consider, or the third type, is really not a gap, it's a range expansion. And what happens is the market's undecided on the day of the news or the earnings report, and it kind of goes up and it goes down, and it expands the range versus what it's normally trading. And really there's a lot of algorithms involved in this, trying to just trigger stops both to the upside and the downside. So the key that we want to do is look at what happens after that range expansion occurs. The fourth type is a mild gap down, which is really just a disappointing initial reaction to earnings, and then the most harsh is an extreme gap down, which is a news event or earnings that completely disappointed the market and everybody was heading for the exit at once. Very critical to note on all 5 of these, the daily volume. We really are looking for a situation where the daily volume gives us a clue into what's going on with the stock. If it's gapping up on big volume and big price gains, this is the most critical, and we want to note that's going on. But also we need to understand that each of these 5, there's 3 different outcomes that can happen, and a lot of it depends on what's going on with the market. It can resolve to the upside, which means it goes higher than the highest point of the gap day. It can resolve bearishly, which means it breaks the low of the gap day, and in this case the gap up put in the top and everybody wanted to sell. Or it can be neutral, where it just kind of meanders sideways and there's really nothing to be done with the stock after any of these happen. Some of the things that go into the overall decision or the ultimate resolution of these gaps is the overall market. This is the most important one, and we're going to go through some charts here momentarily, and you can see as the market started to improve off the bottom, these extreme and the mild gaps up continued to go higher as market leaders. So when you have the market in your favor, they tend to go higher. If you have an extreme gap up and the market is trending harshly down, and we saw this repeatedly during the sell-off, the gap up was immediately sold and it put in a top. So although a gap up can appear to be bullish, if the market is bearish, the odds are that it's going to resolve to the downside. We also want to look at various moving averages. As I alluded to, the 21 or the 50, what's going on relative to the price chart there, and then various support and resistance levels when we try to determine what's going to happen with the 15 outcomes. So I got a list of 28 stocks over here, and I'm just going to go through them one by one, starting with the most bullish over here. So we've got a list of 10, 11 actually gaps up, either extreme or mild, 11 gaps down, 11 gaps up, 11 mild gaps up, and then we've got a couple of range expansion and gap down examples. Because when gaps down happen in leading stocks, it's very often an opportunity to get in if the gap down puts in the bottom of the stock. So the key thing you want to look at on the day of the gap is where is the high and where is the low and how much volume. So the first extreme gap up example that we're going to use here is Fastly. So you can note here, this stock, nothing really special about it, just forming a nice long base until they reported earnings after the close on May 6th. So the next day, May 7th, this had a monster gap up, an extreme gap up, came all the way up to the top of this prior area. It was up 45%, and the volume was 620% above normal. This immediately goes to the top of my buy list, and I started taking small entries in it over the next couple of days. This thin pink line is the 8 EMA. The strongest of these gap ups will never even come back and touch that. But if the stock goes sideways for a little bit, you can start taking entries piece by piece. In fact, it was unfortunate. I owned this stock down here, and I got stopped out 3 days before the gap up because of other rules relative that I use for selling. But I wasn't disappointed. I'm back in it now. I've got over 20% gains, and it is has never even come back to touch the 8 EMA. One of the quickest entries is maybe a touch of the 5 EMA, 5-day average, and that's where I got back in on this. So let's scroll through some of these extreme gaps higher Fastly, as I mentioned, and also notice if there's a flag over here next to the stock, it means we own it in-house. Twilio, same situation, nothing really extraordinary about it. It's just going sideways. In fact, nowhere near being a leader. But again, they reported earnings after hours on 5/6. The next day, it was up 40% on 715% above average volume. Another situation where it got onto my watch list, and over the last couple of days, I've taken a small position in this as it pulled back near the 8 EMA. So we've got the volume going for us. We've got the price action going for us, and most importantly, we've got the market going for us. As you can see over and over again, a lot of positive reaction to these big gaps up. LVGO, another stock, this already was a leader. This was even stronger because, as you can see, it reported earnings even after coming out of a base and running up 41% after this. The market appreciated its earnings so much that it gapped it up an additional, 11% on double average volume. And this is also something I owned. I got back into it as it started to pull back. Datadog is a recent one. Came out of a base. Here's your big gap up. 490% above average volume on 23% with a 24% price gain. You can see these are really it's the equivalent of looking for familiar faces in a picture book. These patterns play out over and over again, and it's your job to find them and get on them. Chegg, something that I just got back into yesterday, again, the day after earnings, up 1,240%. The price gain was 32% on 1,240% above average volume. You just don't see volume like that very often. And when it pulled back near the 80 EMA yesterday, I took a small position in it. Fortinet was another one, a security stock, forming a nice base, big extreme monster gap up, 21% on double average volume, no position on this one. PayPal, very well-known stock, big gap up, 26%, above average, up 14% on 204% average volume. We own this in a couple of portfolios in-house also. Horizon Therapeutics, again, big gap up, monster volume, continuing higher. Etsy, big gap up, continued higher, now pulling back into the 21 with some volume. So something to pay attention to. This may go from its leadership, from a leader to a laggard. I'm not sure what the situation is and why this has been selling off. I don't own this one. I'm just showing the gap up as an example of what happens after the gap. Peloton, another one. Monster gap on earnings, cleared all of this resistance, continuing higher. The next one, Spotify, actually has two different examples. First of all, it has a gap up on earnings that failed. So look at this situation. Note up here, there were a couple of days. This black line up here is telling you what's the S&P 500 doing. Spotify gapped up on earnings, but it didn't hold. The next day, it immediately broke the bottom of the gap. So breaking the bottom of the gap is a bearish situation. So if it goes more than 2% below that, I'm a seller. So I would have been stopped out of this. This was not something that I decided to buy. Either way, for one reason, it tried to break out and failed and closed, excuse me, below the top of the base. But then yesterday, Spotify announced that they signed Joe Rogan to an exclusive podcast, and that news was very well received. And you know, it got a lot of talk that they compared it to when SiriusXM signed Howard Stern. So this was an intraday big move up, monster move, and following through today. So two examples here of a mild gap up, somewhere between mild and extreme, that failed, and then a move up intraday. Again, it's not necessarily a gap, it's an inflection point in this case, but continuing higher. So let's take a look at some that had mild gaps up and see how they resolved as we go on, starting with Camping World. Now I'm calling it a mild gap up because it still stayed within this base formation, meaning it didn't clear out to all-time highs. So you could have the monster volume, which in this case it did. It was 448%, but it didn't have the price action that got it above the prior side of the base. So that's why this falls into the mild category. But you can see, again, using the bottom of the gap day as your sell signal, you would still be in this stock as it continues to work its way higher. Enphase is another one here, 75% above average volume the next day. Nice. So it had the price action up 19%, didn't really have the volume, and it didn't clear the left side. So this was a mild gap, but again, using the low as a sell signal, you'd still be in it as it continues to go higher. Beyond Meat, same situation, mild because it didn't clear. Here's the gap up 26% on 461. You could argue this is somewhere between mild and extreme because it in the coming days did clear this, but another example of one that would continue trending higher. Here's one that failed, AAXN. They're not all going to work, nothing's perfect. AAXN, mild gap up, very nice day, higher high the next day, but it reversed and now it's broken below the low of this gap up day. So you're out with a minimal loss. Always important to obey your sell signals. Roku, here's another one that failed. Gap up here, big volume, very quickly broke below the bottom of the gap up day and now has continued lower. Band, here's one that's continuing to work higher, never broke below the low of the gap day, riding that 80 EMA higher. And Snapchat, same situation, gap up here. This is actually one that I bought but sold recently to move the money into something else, but this is still acting very well, bounced off the 21, still hasn't cleared the left side of this base. Shopify, this was already a leader. Here's earnings, here's your earnings move, and it's continued higher. Square, here's your earnings. This initially, after hours, was down on earnings, but by the next day, people took a little closer look at them and up 10% on 70% volume and never broke below the gap up day and is continuing to work its way higher. And finally, in the mild gaps, we've got Facebook. Here's your gap up on earnings. Now, sometimes you might break a percent or two below, but then you want to look at what is the next area of support here. In this case, it had a big round number area, the 200 area, that it briefly broke below but never went further. So this is one where if you got stopped out, you did. If not, if you wanted to give it a little bit more room because the range of the gap up day wasn't that big from high to low, you can give it a little bit more room. Plus, it's a big cap stock. And if you stuck with it, you'd have been rewarded. If not, you could have got stopped out here and gotten back above it as it broke back above the high of the gap day. And then came back, tested it again, held that 200 area and the 21 day. Multiple ways to play it. I have rules. You may have some that vary slightly versus mine. So the trade desk, let's talk about range expansion stocks now. TTD, they reported earnings. It was in an uptrend. They reported earnings here, and they had a very, initially a gap down, but it was a very wide range day. It ended up closing down 2% on the week or on the day, and volume was double average. Got briefly above it just intraday a couple days later, then broke below it. Sometimes you get them and they go straight up. Sometimes you get them and they the left side of the chart continues to act as resistance. So this is one that really, at this point, has had a neutral outcome. SDGR, Schrodinger, this is one. Here's your earnings day. It had a gap down, and then it actually went several points higher, closed in the middle, 200% above average volume. The market couldn't make up its mind as to what it wanted to do, but it never, in the next couple of days, never broke below the low of the gap up day. And now the last couple of days, it broke above the high finally. So it took a little while, but it resolved bullishly to the upside. Now let's talk about some mild gap downs. And we'll start with Net. This is a stock that I own right now and is acting a little bit strangely. So this actually broke out the day before earnings were announced. The next day, it gapped down sharply and finished down 11% on 250% average volume. But note where it bounced. This is one of the factors that goes in, is prior support, resistance, and moving averages. Never broke below the 21, and then from that bounce off of 25 within 2 days, it was all the way up to 30, so a 20% gain. And now it's kind of been still really a neutral response to this. Higher to neutral, really. It's still above, right near the high of that gap day. Something I'm keeping an eye on. It's still above the 21. I got in on a pullback to the 80 MA around here, so just about flat on this stock. Next one, Vertex, one I've owned for a while. This had a very strong run prior to earnings. Sometimes people take advantage of that and they sell. Vertex was one that gapped down on earnings, broke below the 21, but closed right at this support area, 250. You can see 250 over here. You can see 250 over here. And it closed right on that area. I didn't sell, held on. Sold some coming into it because it wasn't really acting that well. You can see the relative strength, but now it's continued to move higher. Teladoc, another one. This had a gap. This had a gap down on earnings, but this is a situation where a mild gap down. The gap down put in the low. So in this case, the initial reaction was bearish with the gap down, but it continued to go higher, broke above the high of the gap day, and has been riding the 21 day until today. It finally broke below it, as some of the stay-at-home stocks have been getting hit recently with some news that the country's opening back up and the COVID numbers are getting better. PODD, here's another one. This is an example of both a range expansion or mild gap up here, as you can see it. The next day it gapped above, so far so good, but then they announced an offering, which is diluting their float share, and you can see it gap down and has not resolved. It's neutral so far. And then the last one we're going to talk about is our Luckin Coffee, something we owned a little while and sold prior on breaks below using our technical rules, primarily here on 3.6. This was your last chance to get out. Before they announced possibility of some, well, not possibility, they actually admitted it since to fraud, and it gapped down 75% on 1,400% volume. Now, believe it or not, there's people trying to buy this and bottom fish this. Once they confirm the fraud, they froze trading in it for 5 weeks here. It's starting to trade back above. But again, just using, if you weren't in it and you're using the highs and the lows of the gap day, it's trading below the low of the gap day. So this is a bearish gap down and a bearish resolution to the bottom. So that's going to take care of the gap rules. Let's get back to our agenda here and see what's next. In summary, so there's 5 different types, 15 outcomes, and the impacts are: how's the market doing, what moving averages are around the price action, as well as support and resistance. Okay, so we talked about our reentry plan, relative strength leaders, and earnings gap. Now let's talk about what's next. I kind of alluded to this. First, let's look at the NASDAQ 100. In all the nightly videos that we've been doing, we've been talking about how the NASDAQ 100 has really been the leading index, and we've been focusing on stocks on the NASDAQ. Leaders, you can see several examples of them at the charts that I just went through and how strong their charts are. And so far, every test, every pullback, both on the NASDAQ 100 and on the S&P 500, has been contained by this 21-day exponential moving average. This is really something that we're keying on very strongly as far as determining what the next move is going to be. You can see us coming in now near this 3,000 area. Let me go to a 60-minute chart, because we use something called Fibonacci Retracements in here, and basically, if you're familiar with how Fibonacci ratios occur in nature, they occur in chart patterns too. But from this high to this low, the 61.8 retracement of that, now don't laugh about this, is around 29.35. So let's go to a 30-minute chart, and you can see how around this 29.35 area here, really 29.25 up to 29.55, there's been a band of resistance that the market has been unable to get through. First back here, where we got above it for one day, then below it the next day, put in another bottom, tried to get back above it, 29.45. We briefly did intraday, but then failed, pulled back again, held the 21-day exponential moving average, tried to get back above it earlier this week, and then finally did break above it yesterday. Let's look at, we stayed above it yesterday until the close, and then we broke back below it. Now gapping back above it today and coming up into that area. So the key is, what we're looking at is, how is the market reacting around this 25.35? So let's again call it 25.25 to 29.50. How's the market reacting around this area? And it's indecisive. You can see here it failed, here it failed, here it failed. Yesterday it failed. Now we're back above it. We're at 29.66 as we trade right now. Let's see where the market closes relative to this 29.35 area, because not only do we have resistance here, we've got overhead resistance with this 200-day moving average. Remember, market doesn't get into serious trouble until it's below the 200-day moving average. Once you're below it, you get out of the way until you form a bottom. We formed the bottom. We started participating again in this uptrend, but we're coming back up here again to this 200-day moving average. Our initial exit over here on 228 was at 29.54. Right now we're at 29.69, so we're 15 points above it. But think, if you just use this one rule to get out, you avoided this entire drop. Yeah, you didn't get in the bounce either, but you're even, because right back over here is where you got out. Now we're looking for a 1% close above here to get back in on your long term. If you're just taking a long-term perspective, we invest over 3 time frames here, in short-term, intermediate term, and long-term. So long-term, we're not back in yet. Intermediate term, we got back in here and throughout this area here as we started climbing back above, first the 21 and then the 50-day moving average. And now we're watching to see, we're not going to guess if we're going higher and push all our chips in the table. We're also not going to sell everything and think that we're going lower because we're coming into this area. We're going to monitor what's happening with the market and ultimately let the market decide for you. And then, of course, you want to, the keys are, how are the leaders acting? Watching our videos, you know leaders have continued to act very well. The only weakness lately has been some of the stay-at-home stocks. I pointed out to Teladoc before, some of those getting sold off a little bit, but for the most part, leaders are acting extremely well. And now we're going to watch at moving averages and various support and resistance areas. The key moving average being the 200-day overhead. Down below, short term, the 21, as I've said, we've tested it 3 times and held. If we break below it and it rolls over, then we're going to watch and see what happens when we get down near this key area, the red line, which is our 50-day moving average. And that corresponds with this 2700 to 2730 area that we tested and held over here on the left side of the chart. That's exactly where the 50-day average is sitting right here, around 2718. So should we pull back there and then finally break that, that gives us a good chance that we may come all the way down and retest the lows. But for right now, we're not making any predictions. But if anybody's new to this video, you're getting a second chance to get out. If you held on the entire time, you didn't have any sell rules, you withstood the 35% drop. We've now rebounded to where we're within 10% of the highs on the S&P 500. If you gave it back the first time, make a commitment to not give it back going forward. In case we fail at this 3,000 area, then we fail at this intermediate short-term 2868 area, and then if we fail again around this 2700 area. So this is about a 10% range here. A lot of people predicting we're going to test the lows. A lot of people predicting we're going to continue to go higher. We don't make predictions at Revere. We let the market decide the outcome for us. Right now, leaders are acting fine. The main 2 big cap indexes, the S&P 500 and the NASDAQ 100, are acting fine. Let's look at the Dow Jones Industrial Average. A little bit weaker than the other ones, still below the 200-day moving average, but it's above the 50 and the 21. So this gets the benefit on the short term and intermediate term. Small cap stocks have been underperforming to an extreme, finally starting to go sideways lately. Want to see them break above this 136.84 area. You can see the extreme sell-off. This actually got down over 40% during the sell-off, now kind of moving sideways. So there is some hope there. Had a failed breakdown last week and now having a good week this week. And then finally, mid caps look a lot like small caps. Those two usually move in tandem. So that's everything that I have on the agenda. Let's take a look at any questions and charts that you want me to look at, and I'll start scrolling through the questions and go through them. How do you find stocks? Well, I use MarketSmith. MarketSmith is part of the Investors Business Daily product suite, and they provide a ton of different stock lists. And it's a matter of going through stocks that are on the leaders list, researching them a little bit further, determining what, and then picking a couple for your portfolio and seeing what you think is the best. There is no hard and fast rules, but the key one to me is I look for something new in the stock, some reason that would propel it higher, and then I look at the relative strength to confirm that. So those are really the 2 keys. Does it have superior relative strength, and does it have something new that would have it outperforming the average stock? Because otherwise, if it doesn't, you might as well just buy the S&P 500. How do you determine extreme or mild gap? Is there a certain percentage? It's not really a percentage. It goes into 3 different things are factored in. Where the gap is relative to the recent price action, what the volume is relative to the recent volume, and if it got above the recent congestion area. If it has all three of those things, then it's considered an extreme or a monster gap up, and those really go to the top. Those were the stocks like FSLY and Twilio that I showed. It's not necessarily a percentage threshold. You can have a 30% move up, but still be in the base, so to speak. So then it's just a matter of watching what happens after the high and low of that gap day. When you hedge your positions, how much is appropriate to hedge? That depends on how the market is acting. The question is, let's say you're 60% invested in a 100,000 portfolio. How much of a hedge? Again, it depends on what sectors I'm in. It depends on what the market's doing. If we're above the 21, I'm usually barely hedged, if anything. If we break below the 21, I might hedge a little bit more or let individual stocks hit their sell points and get out. If we break below the 50, I really want to have minimal exposure. Next question. Gap up question. How do you know if it's real institutional buying versus a massive short squeeze, which tend to fail? This is a great question. Always check the short float on something. So for example, let's look up FSLY. FSLY, I've got all the information turned off because it's proprietary, but you take a look at how many shares are in the float. You take a look at what the short float is, and you determine the percentage of the short float. Percentages of short float, and I think that this is what happened with AAXN. I believe that this stock had a large short float. It gapped up. It takes about usually 2 to 3 days for the shorts to cover, and then if there's not demand for the stock, it's just going to fall from its own weight, and I believe that's what happened with AAXN. So that's why we take a look at the high and the low of the gap day and the action relative over the next couple of days to what's happening with them. So you can see this had a nice day 2 higher high. As of right now, it's bullish. Then it starts to break back into it. This is really normal action so far. Then it got back to the pivot. Again, can still give it the benefit of the doubt. But when it breaks below the low of the gap day, this is saying there's no demand for the stock, and you just compare that to a chart of something like FSLY, which you can see continued higher, Twilio continued higher. Question is, when you refer to the leaders, do you mean the stocks that are up the most during a certain amount of time, or the stocks with the best fundamentals? It's a combination of the two. I don't want something that has no sales. For example, I don't really trade in biotechs that have maybe phase 2 or phase 3 trials but haven't realized any sales yet. So it's a combination of fundamentals and technicals. But then after you get into something, you sell specifically on the technicals. You don't wait to for the fundamentals to deteriorate. Next question, can you look at Beyond Meat, BYND? Let's just use the monster gap rules on this, and it's acting very well. Obviously, euphoria that we had coming out of it, and then it started forming this big base. The coronavirus hit, it started going down. Now we start hearing, hey, we might be having meat shortages, so it kind of starts to go up, runs into the 200-day moving average and can't get above it, so that's a failure at that point. But then it reports earnings, and the earnings are received very well. It gaps up 461% volume, 26% move, and then you just look at the gap up day. What's it doing relative to that? It had 1 day within it. The second day after the gap up, it broke above the high. Those are all very bullish situations. Then it starts pulling in, bounced off the ADMA. I mean, it's bullish. And it got above this 135 and 129 areas, which were support on the left side of the chart. And that's kind of where it's just going sideways right now. But nothing here to cause any concern on Beyond. And the gap rules are working in its favor. Can you analyze mRNA? Well, mRNA unfortunately has a lot of emotion tied to it. Let's just go by gap rules on it. So here it had a mild gap up after earnings. It was up 8% on 75% volume the next day. Again, good volume, and it took out the high. So this is very bullish so far. If you're just using gap rules, you're still in it. Now, yesterday, then it consolidated a little bit. Big gap up when they put out a news release saying we had good phase one reaction to our coronavirus. And they immediately announced a secondary at $76. And then yesterday, somebody published an article saying they didn't really provide enough data. We think this is a fraud, and and it dropped by 10% on over double average volume, triple average volume. And today it pulled back. From a bear perspective, you got negative news on this, so you got to be concerned. There's also 90 other stocks that are or 90 other companies that are working on vaccines. But it pulled down, it held right at the top of this little consolidation here, and it bounced off the ADMA. So far it's fine. This isn't something I would hold a huge position in because of anytime anybody's throwing the fraud word around, I get nervous. Sometimes it's real, sometimes it's not. Supposedly there was a class action lawsuit that was supposed to hit today because of some people that got in on the secondary at 76 before the fraud allegations were published. So you never know how things are going to react. But for one thing, on this gap, it broke below the low of it, so you could have sold based on that. And then it's bouncing at the ADMA, so you could buy on that. But either way, keep your losses small. Who are your favorite people to follow on Twitter or FinTwit? Revere Asset Management is all you need to follow on Revere on Twitter and FinTwit. I mean, I follow a lot of different people. I don't make any decisions based on anything that anybody is saying on Twitter. I do my own research and react accordingly. And you should get a system and do it the same. Any other questions? We're slightly after 1 o'clock, so if you have some, I'd love to hear them. If not, I'm going to wrap it up. Can you look at Marvel, MRVL? This is very nice, has earnings coming up. Not sure what the reason for this gap up was on Monday. It's been choppy for a little while, but if you look at a weekly chart here, this is approaching all-time highs. Any stock that approaches all-time highs is good. You can see the relative strength here has been superior for the last 1, 2, 3, 4 weeks. So that's something that stands out to me. Relative strength at a new high. Note relative strength is at a new high before price is at a new high. That's very bullish. It's acting well. It's in a leading group. Semis. It appears to have dodged any bullets that were fired. As far as having China exposure, there were 8 stocks that really got hit on Monday because of the supposed China tariffs coming back in. And it looks fine. Breaking out. Volume above average today, 59% above, and it's up 5%. And that's going to wrap it. Looked at beyond. Yep, that's going to wrap it. We're after 1 o'clock now. So again, check out our website. You have any questions? Email me if you have any questions. Always looking for feedback. I'm on Twitter at D Vandenbord. Email don@revereasset.com, or you can call us on 855 Real Wealth. I appreciate everybody's time today. Thanks for joining, and have a great day. An archive of this will be sent out this evening. Thanks, everybody.